Hello, I'm Kim Parlee. It's great to have you with us tonight. The U.S. government shutdown, unresolved U.S.-China trade wars, and Brexit are just some of the concerns that are fueling the increasing fear of a coming recession. But are the mounting worries justified? I spoke to Beata Caranci. She's chief economist at TD Bank earlier about some of the economic indicators she is watching closely and a report she called "The Only Thing to Fear is Fear Itself." Let's start with volatility, because, it doesn't feel good for the past few weeks.
No, and part of it is, I think for most investors, it feels like you just had a bucket of cold water splashed on your face, because we went from an immensely low volatility environment, particularly in 2017, where we were well below average for equity volatility, to slightly above average where we are today. And so certainly if we try to gauge where we are in a business cycle based on equity volatility, we would be making our third recession call right now since the recession, which would be incorrect. So we never really want to rely solely on equity market and movements. The volatility that we see is actually consistent with central bank tightening. When you are in later stage business cycles and the central bank tightening is also in a more mature phase, meaning they're not at the very beginning of it, you tend to see more equity volatility. But certainly there's other factors now impacting it. Obviously, a lot of event risk related to Brexit, U.S. government shutdown, and trade unresolved yet with China and the U.S. So a lot more factors that is making sentiment a bit more sensitive as we go through week-to-week data.
Right, and I think we'll get to the capital S sentiment in a few minutes in terms of one of the issues where we're looking at yields and spreads on corporate bonds are up. Again, that's going to affect the markets as well.
Yeah, so it's interesting because if you were to rank order indicators that you follow as a better indicator of where you are in the business cycle and how close you are to being in a recession or moving towards a recession, I would actually put corporate spreads in the middle of the pack, not actually high. At the highest level are your U.S. Treasury yield curve. When that inverts, that's a very clear recession signal. We're not there yet. Corporate yields can give you a little bit of either mixed signals or very late signal. So an example would be that when we were headed towards the 2001 recession, we had corporate yields falling. There were substitution effects happening, and it was falling across all investment grades. When we were in the 2008 recession cycle, the peak in the spreads occurred well into the recession cycle. So it's a good indicator to follow because it obviously gives you an indication of market sentiment and risks, and that's getting paralleled in stock market movements. But I wouldn't say it's the indicator to follow. And certainly with the level of spreads that we're seeing today relative to the past, we are not even at spreads that are as high as what you would have seen in 2015, 2016, when there was angst around China's growth in particular. So they're higher than we've seen in the past. They're sending up little, maybe yellow flags, certainly not red flags.
Okay, well, what about the yield curve? You were talking about this is something you do want to watch. So what is the yield curve telling us right now?
So the shape of the yield curve is a very good predictor of recessions. It has been accurate. It's 3 for 3 on the last recessions. It does give a good lead time of 1 to 2 years. In the past it could be less this time around. We are still seeing a positive spread between what the typical term followed is your 10-year versus your 2-year spread or your 10-year versus your 3-month spread. And basically that's still positively sloped. The recession indicator is when it inverts, so your 10-year yields are below those of your short-term yields, which basically is saying the markets think the central bank has made a mistake, so their policy path for the central bank is falling in the long term, their inflation expectations are falling, and that pulls down your long-term yields, but your short-term are still being pegged by your policy rate, right? And so the expectation is they're going to be reversing course.
Right.
So we still have a positive spread of about 15 basis points for the U.S., and that's basically par for the course. We're in a rate hike cycle. And so you are going to see a narrowing of those spreads. What we would be concerned about is if we saw the inversion, and we're not there yet. But if you are to see the inversion, that to me would send up a red flag.
Okay, so again, 3 for 3, that's one to watch as we move forward. You have a number of other indicators you talk about in this report, and one of them is something called the Economic Risk Index. What is that, and what is it made out of, and what does it show?
So this is our in-house economic monitor that we put together. And it's a function of a lot of economic leading indicators related to a cross-section of the economy. So things that relate to the consumer side of the economy as well as the production side of the economy. And so this indicator, and this is US specific, is telling us that we are on average growing in the US above the historical average. So the indicator is not telling us that we've had strong transmission of the financial stress into the economic data, which is good because the way we think of it as an economist is basically your financial market stress that comes through equity markets or bond yields is a first order condition that you would need to be satisfied to tell you that you're moving towards a recession. But the key one is the second order condition. Is it bleeding into the real economy, affecting consumer and production behavior? We're seeing some of that, but certainly we're still holding at above average levels.
Confidence. Let's talk about that because that's, you talked about sentiment earlier. I mean, when I see my portfolio drop, I don't feel like spending so much. And I'm sure when businesses hear about people talking about recession, whether actually it's happening or not, they start thinking, I'm not going to spend as much either.
Yeah, so you could say one for one, if the consumer believes there's a recession and behaves as if there's a recession, you will be in a recession because consumer spending in the US is about 70% of GDP and in Canada about 60%. So once the consumer behavior is mirroring that of pulling back spending, it's game over. You're likely going to be in a recession. So we don't actually wait for consumer sentiment to deteriorate because we would probably already be in a recession and so the signal's too late. What we'd be focused on is whether we're seeing a deterioration in business sentiment that might alter hiring and investment intentions, which subsequently leads to labor market outcomes, which affects the consumer behavior.
Right.
And so these are what's called PMI indicators of like how are your order books doing? What do your shipments look like? What does your hiring intentions look like? And this we did see a deterioration occur not just in the US, in China, and in Europe. So we're seeing a broad slowdown happening in these indicators. They are not flashing recession levels, still well above that, but they are certainly consistent with slower economic growth, not no growth, but definitely slower economic growth, which was always built into our forecast. We had gone from a period of above average growth in Europe even, especially in China and even in the US, and this is part of that normalization cycle. The question for us, especially in the first quarter, because we started to see the deterioration come through in the December data, is how far does that go? Does it start to stabilize? And our belief is it starts to stabilize at near these levels. If it continues to deteriorate, we worry that you hit a point of no return.
The last one you talk about, which I love, is the Beetlejuice syndrome. Yeah. My favorite movie. So what is the Beetlejuice syndrome?
Yeah. So this is really just a movie that if you say Beetlejuice too many times, you have this basically a monster appear. And so the monster is the recession. Yeah, don't say it. So this is the concern that goes back to the consumer psyche, that if people believe we are in a recession cycle, they will alter their household spending accordingly. And that actually is what economists talk about as being the paradox of savings, which is if you or I are saving for some goal of improving our own business finances or our household finances, that's not a bad thing. But when everybody collectively does it, it pushes you into lower income outcomes for the economy, which causes hiring to fall, and you get this self-fulfilling cycle. And so that's what I'm saying by the Beetlejuice effect, that if more and more people start to believe and hear about recession, when we're actually not in one, we're not even close to one yet with the data, it could be self-fulfilling.
And are you hearing, I mean, again, I know by talking about this, we're actually doing the exact thing,
Exactly.
But I mean, we've seen polls and things coming out and people are starting to feel that way, even though the data's not showing it.
Yeah, so I found one survey really interesting. It's an American survey coming out of Duke University, and it's of CFOs of businesses, and almost half of them are citing that they think the US will be in recession in the next year, 12 months. But yet all of them had economic growth forecasts higher than our own. So there was an incongruency happening between what they're saying in terms of what they actually believe the economic outlook is. So that is a little bit of worse in that we need people to match up the rhetoric to the data. And right now the data is doing better than the rhetoric.